Hello, everyone, and welcome to Long Options here. I am Rachel Deschelle, Senior Manager of Trading Services here and your host for Long Options. I am joined in the chat today by Cameron May. Please feel free to chat in your questions, comments, requests during the session today. And please follow us on X. He is Cameron May CS. I am Rachel-CS. And please like this video if you like this webcast today. And please subscribe to our Trader Talks channel on YouTube. Now today we are going to go through some bearish setup examples for some swing trades for options. So stay tuned for that. But we're first going to start with our important disclosures here. So first and foremost, options carry a high level of risk and are not suitable for all investors. The information that we're going to cover here today is for general informational purposes only and should not be considered any type of recommendation or advice. And we're going to go through the Paper Money platform today, and it's provided for educational purposes only. There are some differences between live and Paper Money, so keep that in mind. Now, today our agenda is going to be discussing the concepts of long options like we do, reviewing our old trades, placing new ones, and discussing concepts of price, time, and volatility. Now let's get into an announcement before we dive into Think or Swim. So we do have some upcoming workshops and events. So the first one coming up here just within a couple weeks is in Miami. It's an advanced options workshop there the 19th and 20th. Then we do have two more trading options and technical analysis workshops in Dallas, January 9th and 10th. And then we have one in Bellevue, Washington, January 30th and 31st. So let's start with a market overview like we typically do in this class by looking at the Dow Jones Industrial Average first. So looking at the last few days of trading, even last week, we saw that bounce and we reclaimed that 20-day moving average there in blue. Also reclaimed that 50-day moving average as well. And it honestly, so far, it looks a little bit like a flag pattern where we see that steep ascent of that flagpole. And then we have this little bit of a pullback here so far. So that could be the start of a possible flag pattern. We shall see. But that is something definitely to keep an eye on there. We have a little bit of a doji candle today showing that pause, maybe a possible reversal there. We'll have to wait and see for today's close and follow through there. Now, looking at the NASDAQ, we see we are up today as well. We have, again, seen that steep ascent, that steep bounce, and we have 1, 2, 3, 4, 5, 6, 7 consecutive days of trading in the green for the NASDAQ. So the next area of resistance will probably be right around this gap ledge, right around 23,660, right around there that traders may be watching. Now, the S&P 500, let's look at that one as well. We're seeing a similar kind of pattern take place in the S&P 500 as we saw in the Dow. So we obviously had this touch of horizontal support here at the 65.50. We bounced from that horizontal support, reclaimed that 20 and that 50-day moving average. And now we're having, again, a little tiny flag pattern that could be starting. So possible flag pattern there. And these are bullish continuation patterns. So this is when price moves higher with kind of a steep ascent there, creating that flagpole, and then consolidates for a few days or a week or two before continuing that move higher to the upside. So now that we've done the market overview, let's take a look at some of our trades that we placed over the last few weeks. So we had our TJX trade that we placed, and this was our long call, our leap trade, and we can take a look at that on the trade tab here. So we're up a little bit on this trade, down on the day, but we still obviously have a ton of time. We have the 15th of January of 2027. And I moved up the stop a little bit as well, just because price has moved quite a bit since this breakout and support retest there. So I moved up that stop. Now, last week we looked at some healthcare stocks. We placed some bull call or bullish call trades on that. and we did CNC and GHC here. So I'm going to open those up so we can see. So we are down a little bit on those, up on the day. Obviously, of course, we'll look at a chart in the next minute or so, but these are just kind of a reminder of the trades that we did this last week of buying some of those pattern breakouts. Now we're seeing almost like a support retest of some of those. So if I look at CNC, that trade that we just looked at, we're still seeing that cup and handle pattern where we decided to buy that call out of when it broke out on that day. Now it's coming back into that support zone for another retest there. And if it enters back into the pattern even more, we have that stop that will stop us out to cut out any losses there. So that's that one. And then GEHC, let's take a look at this one as well. So we were looking at this very long range. We saw this strong break of the range, and now we're having a little bit of that support retest here. And if I zoom in a little bit closer, you can see it almost looks like it's forming a possible flag pattern on this one because we had that steep ascent that only took a few days. Now we're having a teeny bit of a pullback here, almost like a pennant pattern with that support retest. So we have our stop right under there in case it re-enters into that pattern and that pattern fails. But we will move that stop up as we go if this continues its move to the upside with that upper break. So now that we've reviewed some of our trades, let's go into some of the trades that we're going to cover for today's session, because I know lately we've done a lot of bullish trade setups. We haven't done a lot of put buying, and that's because there has been so many charts that have given bullish setups, but I dug through some charts and found some that are looking like they are in a strong downtrend and are giving us some bearish signals here to possibly buy a put option on, which gives us obviously that right to sell the stock at a specific price by a specific date. And it allows us to profit on a down move in the stock. So that can be something that we can use today in some of our trend trading and swing trading ideas here. So the first one that we're going to look at is Affirm. So AFRM. And the first thing I kind of look at when I see that an uptrend has been broken and we may be forming a new downtrend here would be the fact that this entire time we were making higher highs and higher lows. And then we suddenly broke this spot where we are now making lower lows and lower highs here. And it seems like each time we are finding resistance at the 50-day moving average. So we rode that all the way up with this trend where we had a couple touches and those were bought at support of the 50-day leading up to the trend. But then when it had this gap below, it retraced back up to that level right about there. It did it again right here and failed to really reclaim it for multiple closes there. And it's still now under the 50-day. With a slope down here. So that's also something that that traders can use as an real easy glance at what a trend is doing, is not only where the stock is trading relative to those moving averages, but also just the slope of those moving averages as well. And right on this one where we saw that pull back to old support, new resistance, we had that bearish cross, or that death cross, as we would call it, where the 20 period crosses below the 50 period, and it's been in a downslope ever since too. It looks like we're kind of battling with that right now, but still the trend is down. We have not made a higher low yet, and that would be kind of the first indication of this downtrend possibly reversing there. So in this case, this gives me an indicator to possibly buy a put here with Affirm here, just because of the given trend. We're not necessarily seeing that type of bottom, since we're seeing, we're seeing those lower lows still getting made in the stock price here. So we haven't seen that higher low yet. We are still seeing a lower high here at the same time. So that looks like a downtrend to me. So if I am looking at buying a put option and riding this trend wave, I may want to give myself just a couple months in time as far as crafting an option strategy to take advantage of a possible swing down in a firm. Now, the other thing that we may look at as well is where the implied volatility is at for a firm. Now, something that we always kind of keep an eye on, and I put these little icons on the chart at the bottom there, is the earnings dates. Now, we just had earnings last month, almost a month ago. And typically before earnings, we know that we kind of see that increase in implied volatility. It tends to increase before then, tends to decrease after those events. So let's just take a look at where implied volatility may be right now to make sure it is a good type of environment to be buying an option. So I'm going to add the implied volatility down there, hit OK. And we can see down here, this is going to show us all the levels that implied volatility has been over the last year. And right now we are down here, I would say on like the lower fourth of where we've been over the last year or so. And another place that we could actually look at kind of the relative high or low levels of implied volatility is on that trade tab, looking at all products and going underneath to today's option statistics. This will give me right here an indication of where today's implied volatility ranks over all the days of the last year from 1 to 100. And right now the current implied volatility percentile is about 22%. So we're still in that lower fourth, just kind of like what we noticed with on the chart of where implied volatility has been. So that tells us that this could be a good time, good volatility type of environment to be buying options in this case. So we already talked about swing trading this. We looked at the 20 and the 50-day moving averages, which are kind of short term. Obviously, that 20-day moving average is about a trading month. The 50-day moving average is close to 3 months of trading. So we are going to ride this trend and buy that put option with a couple months left till expiration. So let's just take a look here at what we have on the option chain. So let's take a look at, I know 45 days, that's kind of cutting it a little bit close to where our time decay would kind of kick into high gear here. And I'm going to change this, this here. Now, if we want to look at a little more than 2 months out from expiration, which is kind of what I'm going to look at here, about 80 days till expiration, to make sure that we don't see a ton of time decay as we're kind of riding the wave of this trend. Let's look at the 20th of February 2026 there. And I'm going to collapse the sidebar so we can take a look at the option chain. And we're going to just discuss some of the things that we typically discuss in this class when selecting a strike price. So a couple of things I want to look for is obviously levels of volume and open interest, because that will give me an indication of the liquidity within the options. And we can see if we just look on the right side here under the in the money put options, the spread on these is pretty tight. We want to look for a spread that's less than 10%. So we are A-okay there. We got the green light there as well. Now, as far as selecting a strike, we want a little bit of we want a delta greater than 50 in this case. So we do want that intrinsic value. We do want an option that is in the money, because if we have a $1 move on the stock, that's roughly how much our option is going to move. And it has a negative delta because obviously puts move inversely. So if the stock goes up $1, the option is going to go down theoretically that amount, and vice versa as well. So let's take a look at doing let's say we're looking at the 75 strike put here. So I see that this is $5 in the money. It has a tight spread of 10.95 to 11.25 here. It has 2 contracts traded today, a few hundred in open interest. So that is good enough for me to take this trade here. So I'm going to right click on this option, buy custom. And since we're riding the wave of with our trend today in some of these trades that we're doing, we're not going to put a profit target on it. We can set some alerts, but we're going to let our profits ride and then move up our stop accordingly. Now we are going to still use a stop for some downside protection to make sure we are managing our trade risk and staying within the risk parameters of our account, which we always talk about in this class about how we are risking, or I guess we are placing roughly 5% of our account into a trade, which equates to roughly $6,300. And then we are only going to risk a little over $1,000 on each trade. So we want to make sure that we do have a tight enough stop with the number of contracts that we're going to be trading. So I'm going to click with stop here. And this is going to show me the order entry tool at the bottom here in this case. So we can see that we're going to enter this trade today. We're going to try to go for the midpoint there with a little bit of price discovery. Obviously, we're not due a fill at the midpoint there. And then as far as our stop, let's just kind of see, just based on the price of this option being $11.35, so it's going to cost us roughly $1,100 per contract. Let's just bump this up a few contracts, maybe do 4 contracts here. And that will give us a little bit of more size to that position. Now, the thing that we have to keep in mind, if we bumped this up to 4 contracts here, we also need to make sure that our stop kind of equates to not risking more than that $1,000, or I think it's like $1,100 or $1,200 on any one specific trade. So let's look at possibly looking at a 70% stop. So if this price of this option goes down 30%, we are going to get stopped out. So let's just do the math there. 1135 times 0.7. That would give us we're just going to put it at $8. It gives us $7.94, but we can just put it at $8 a little bit there. So the difference between 1135 and 8, 1135 and 8 is 335. And if we're doing this for 400 shares or 4 contracts, that's actually risking a little bit too much, because if we take 335, the difference between our entry and our exit, and multiply that by the number of shares we are controlling, that is a little bit outside of our risk parameters there, at risking $1,340 in the trade. So we're actually going to bump that up a little bit more. And let's just say we move this to, we're just going to go to, let's just say $9. So we'll put a $9 stop there. We take 235, the difference between those two, times 400, and that gives us 940. So we could go a little bit lower if we wanted to, but we are staying within the risk parameters of our account there. It is kind of a tight stop in that case. So if we want to go a little bit lower, we can, but we still want to make sure we are not risking too much in this case with our trade size here. So another thing about stop orders is that when the price of the option hits that price, that order is going to become a market order. So it's not a guarantee that we're going to get out at $9. We're going to get out at the next available price once this order kind of ticks there. So we're going to make this order good till canceled. We're going to hope that we're going to try to get a fill right away on the first triggers order, so on the buy order of the put option. And we are going to have our stop in good till canceled to ride that wave. And again, we are not placing a profit taking order in this case, because we do want to trade with the trend in this case. So we're just going to move up the stop as we go. And let's talk about, before we when we hit confirm and send here, how much we are risking. So we are putting our max loss is what we are paying for that option. So that's definitely going to be that premium that we are paying, that $11.35 or so. times 4 there to get us that 4,500, but we're only going to risk roughly $940 on this trade because we have our stop in place there. So double checking that, placing it in the long options trade there, and I'm going to hit send. Okay, we have that there. So that is in and working. I'll double check on that if we don't get a fill here in a minute. But let's move to back to the charts and go through the next example here. So I'm going to look at BABA here, Alibaba Group. And this is an ADR, so I want to just kind of make sure you guys know, as far as foreign securities traded on domestic exchanges, they may be subject to additional foreign tax withholding requirements, as well as just additional risks. So kind of keep that in mind since we're using an ADR as an example. But in this case, if we were just looking at the trend of Alibaba over the short term, really since these highs were made, we can see that we are making lower highs in this case, and we are making lower lows because we made a lower low, another lower low here. This could have still been that higher low within that ongoing uptrend, but as soon as we made that lower high and that lower low, that gave us that indication of that change of trend. And another thing that we talked about with the other example was looking at the slope of those moving averages as well, and where the stock is trading with kind of in proximity to those moving averages. So we had that death cross there that occurred right there at that low candle. The stock is now trading below its 50-day moving average, and again, trading right on that 20-day moving average. This one sloped straight, and this one sloped down. So that tells me in the near term, we have a downtrend here in the near term. So this is another one where we will be looking to buy a put on it. Now, as far as looking at some of the other considerations that we talked about before, we're still going to give ourselves a couple months of time for this trend trade to possibly play out. We do want to look at implied volatility and see where it is relative to where it's been, and we can see that it is at a very low level to where it's been over the last year. And then we will also just kind of look at, then once we're selecting that expiration date, we'll look at our strike prices as well. But I want to look at the chat here because I do see some questions in here. So let me just take a look to catch up. Let's see. I see one about, do you prefer using the option premium for stops, or would you rather use the price of the underlying as a trigger? So you could use either. I know traders use either or both. For people that are wanting to have just more control over the price of that option and more control over kind of that trade risk, so to speak, where you know exactly where you're getting in and exactly where you're getting out when you're wrong, people tend to prefer using the price of the option in that case. Now, the kind of downside to using the price of the stock as that indicator is you don't know what the price of the option is going to be during that time. Now, you can certainly use that Theo price tool on the option chain here, so I'll jump to that, where if we kind of look here, you can go to Theo price mark, and you could do your adjustments if the price of the stock moved up or down within a certain window of time. You can do your volatility adjustments to really see theoretically where it would be. But the reality is, with that conditional order based on the stock, we don't necessarily know where that option price is going to be. But the benefit of that order is you can still use like a limit offset order in that case to still have control over the price when placing that. And why not use trailing stops? So I'm not using trailing stops in this class, but we could use trailing stops. So that could be something that you could use. And that's essentially going to be a little bit different, obviously, than a traditional stop order, because that's going to be a more dynamic stop that's going to move up with the price of the stock. And it never moves away from price, where with the stop market and stop limit, you're kind of putting in one price and then you're executing a market or a limit order. We are not going to go through that today on our examples, but I actually did teach a smaller account class yesterday where we went through using trailing stops and kind of some techniques using those. Let's see. I see another question here. Do you worry about bigger spreads during after hours for stop orders with spreads versus using conditional orders on the underlying? So if I understand that right, so the risk with using that is obviously the options don't trade in the extended hours, but the stock does. So like if it, let's say the stock gaps down on the morning or trades below your stop, with that stop order, you are getting out right away, especially with that stop market. And there could be wide spreads at the kind of open of the market where you have that rush of orders kind of hit the market in that case. So now as far as using conditional orders on the underlying, that's still going to be, since conditional orders don't work in the after hours, it's kind of going to be a similar type of limitation there. So just kind of looking at where the stock would be on the open. Sharon, why not 3 contracts and give a looser stop? We could definitely do that. But just for this example today, we wanted to have a tight stop in there. Let me scroll down to more. We have so many questions, guys. Thank you. Okay. You suggest utilizing EMAs on smaller time frames and SMAs for higher time frames. So the exponential moving average versus the simple moving average. So there is no recommendation on which one to use. I mean, the main difference between the two, because obviously the time frame is going to be dependent on what the time aggregation that you're going to put into using that particular indicator or whichever moving average that you're using. But the main difference between the exponential moving average and the simple moving average is that simple moving average is going to have a little bit more lag because it's just a traditional arithmetic moving average. It's taking those closing prices of each day as the next day forms. It's picking up that day in the average, dropping off the first, whereas the exponential moving average is going to place a lot more importance on those more recent data points. It's going to place a lot more importance on those. So it's going to move more swiftly than the simple moving average would do. So if you're someone that is looking for a little bit of an earlier signal, a little bit less lag, you can actually, you may want to use the exponential moving average as well. And I'll show you an example here. We'll add the exponential moving average and see how different it is from the simple. Let's just use a 50 period in this case, and I'll make this in a different color so you can see. Okay, so if we use the 50 here. Okay, oh, it's really small. Let me make this a little bit bigger for you to see here. Gotta change that width. Okay, so we can see that with this 50 period moving average, it's obviously going to hug price a lot closer than the white one. So we're looking at the purple and the white one, and we can see the purple one is going to hug price a lot closer and going to give you a possible earlier signal if it's going to cross above or below that. In this case, it gave the signal on the same day, it looked like, when it was looking like it was going to cross both of them. But as you can see, this one really started to kind of flatten out or plateau before this one really did. So it's going to remain closer to price just because of that more weight on that more recent data points. Okay, we're going to take that off there. So let's remove that study and let's look at what other questions. Does Theo price work differently? Let's see. I think Cameron's answering a lot of these. Okay. So it looks like Cameron got the rest of them there, but I showed you that example there. So let's go back to BABA here. We talked about buying a long put a couple months from expiration, and it's also a good type of volatility environment for a long option buyer. If we just kind of look down at that IV percentile, it's kind of like what we saw on the chart. Implied volatility is really, really low. We don't have any upcoming earnings or upcoming events. So we can hold this option here. Now let's take a look at the 20th of February in this case. So we're going to just look at 80 days left till expiration. Same thing that we did in the last one. We're going to make this the Greeks and volume and open interest and collapse that left sidebar to see here. So we can see with the open interest and volume, we can see there is a lot of open interest, thousands of contracts, some of these hundreds of contracts of volume traded today. And the spreads are pretty tight on these options too. So with this option, we are going to look at an option that is slightly in the money. So let's just look at the 165 strike put there. So 165 strike put, it is $5 in the money there. We notice a couple other things as well. So if we're looking at our Greeks here, just since we have the option chain showing them, our delta is going to be 52. Or I guess, which one are we at? 52 in this case. And our, which means that we have a 52% of this percent chance of this option expiring in the money. And then our theta, that is our time decay. This is showing us how much we will lose as an option buyer, theoretically, as each day passes. And then our vega is that measure of volatility. So if we have just a 1% increase in implied volatility, theoretically our option is going to move up 30 cents there. So a couple other things that we're kind of keeping in mind. But we're going to do a similar thing to what we did in the last trade by right-clicking on this option, buying custom with stop here. Okay, so in this case, we are going to place a limit order to enter into this option, and then we are going to place also a tight stop in this case. Now, let's just look and calculate how much it would be if we were looking at a 70% stop. So if we took 1410 times 0.7, that gives us about 9.87. So let's just put this at $10, just a little bit above that. We're going to make this order good till canceled. Now, we can do roughly 2 contracts here in this case with this put option because we are going to be paying about $1,400 per contract here. So in this case, we're going to be spending about $2,800 into this trade. That's our max loss. But we're going to also note the difference between our stop price and our entry price there, which is roughly $400 of a difference. We multiply that by 2, we're only risking $400 there. Now, what you could look at for a stop is you could always increase the number of contracts if you do a tighter stop, but we're going to give ourselves a little bit of wiggle room here, and we're going to hit confirm and send. Now, similar to the last one, we're just going to let our profits ride. We're going to move up our stop as if the price of the stock moves in our direction, and we can set alerts on that as well, and we can look back at the chart to see some levels that we may be targeting too. So we'll circle back to that. I'm going to click long options to make sure we place that in the right account and hit send. And I do see a question from Mark about different options expirations. So sometimes if there is a corporate action in the stock, they may have contract changes as far as not a standard contract with 100 shares being the deliverable. Sometimes it's 100 shares, or sometimes it's a certain number of shares and cash as well. So one thing that you can do is look at, in this case, we're going to avoid non-standard options because this is really what they're called. But essentially, you'll want to go to the OCC. They have a memo page. Let me see if I can find it. OCC memos. Let's see. I'm going to pull this up here. Okay. So if you see that on the option chain, if you see that where it's a non-standard contract, it says something other than just 100, that is kind of your indication to go to the OCC if you have that contract, and you could actually look at, let's see if this works. I haven't used this in a while, but if we use BABA, there's no results there. You can change the date and all of those as well. So that may be something that you want to do. But if you just go to infomemo.theocc.com, that's going to take you right there to actually give you a memo from the Options Clearing Corporation to see what the deliverable is. So let me just send that link to you guys. Okay, and I'm keeping an eye on the chat because I know we have a few other questions. Let's see. Oh, and that one is a dividend payout. You guys are right. Yeah, that one could be a dividend payout because it is an ADR in that case. But a lot of times, if you see that for common stock as well, use that info memos. Let me see. I had questions about gamma. Okay, so I thought gamma was the amount that changes delta, and then delta is the amount changed to the option price per $1. You're exactly right. So if we look at the Greeks here in this case, if we look at gamma, I was always taught that gamma, G for gas pedal. It's really that rate of change of delta. So that gamma is going to be the highest for the at the money options. They're essentially going to be more sensitive. Their option prices are going to be more sensitive to changes in the price of the stock because they have a higher gamma in that case. So when the price of the stock does change, that delta is going to change quicker and quicker for those at the money options. Now you'll typically see a higher gamma in weekly options as well. So if you look at the gamma here in the weekly options, you'll kind of see some of these are about 3 cents, 2 cents. The other thing as well is that the closer you look to expiration, your gamma is going to get higher and higher. So you can just kind of see we went from 1 penny to about 3 pennies there. And really it's going to equate to like that volatility of the price of your option in a sense, or that rate of change in the price of your option, I should say. So hopefully that helps on the gamma. Now let's look at, because I promised we would go back and look at these charts to see where our possible downside targets are on these two trades. And we're going to set an alert based off of that as well, just to kind of keep an eye on these trend trades as we go. Now, as far as BABA, I think the first level that a trader may be watching is probably this long-term level of support here. So I'm going to draw this going all the way back to earlier this year. We had price really retrace that entire amount to the breakout from earlier this year. And so that zone about 10 points from where we are now will probably be that next level of support, because that's where those previous lows were also. So if this trend is going to continue, if we are going to make a lower low, we'll likely see price hit this area first and possibly break that unless it holds that support there. So that may be an area where I actually choose to place a alert on, is that level around 149 or so. So I'm going to click on the price here and I'm going to create an alert, and we're going to say the stock is at 149. And that's going to change us to at or below. So I don't know why that's popping up. So BABA stock mark price is at or below 149. We're going to get an alert if it breaks support there or touches support. So that may be an area that we're targeting there. Now to the upside, as far as resistance, where we could get stopped out at is around this trend line here. But that's going to be kind of like our descending trend line resistance. That's kind of right around that 50-day moving average as well. So we'll kind of keep an eye on that too. Now, as far as the first trade we did, Affirm, where we did see those lower highs, lower lows really taking place here. If we just look back at where those previous lows have been, if it's going to make a lower high in this case, and we assume that it's going to make a lower low if this trend isn't going to turn around here, we can look at this as kind of the first level to watch here around $60, where the low of that previous candle is. So $60 may be an area where I may create an alert, and I'm going to place this at $60 here. And I'm going to hit create. Okay. So we have a couple alerts there. And let me see, what other questions do we have? Let's see. When the expiration date comes, can you roll if you don't stop out? If so, what would you consider as criteria for rolling a long dated put or a call buy? So some folks will roll the option based off of the amount of loss or gain. Sometimes they may roll the option based off of where their delta is. So if their delta gets to a certain point where it's moving too far in the money, they may close out that option, or if it's moving further out of the money, they may close out that option too. So just a couple different ways where you could roll that option to that next expiration series there. And if you want to create an alert on any of these things with the option, you can right click and just create an alert. And this one will not only give you the opportunity to just create an alert on the price of the option, but you can also use that for your delta there as well, which I know some traders may use when considering rolling out those options to get alerted when their delta changes to a specific level. Okay, what other questions do we have? Affirm, let's take a look at that. That is a financial stock. I think we may have already answered that though. So that is in the financial sector there. BABA descending triangle. Let's see. Let's take a look at and see if we can see a descending triangle. So let me remove some of these things here, and let's just kind of take a look at the price. Remove some of the studies. Descending triangle, not necessarily. It almost looks like a descending channel. So, or maybe a falling wedge even, kind of close to that, because these lines aren't exactly parallel. They're kind of looking like they're converging a little bit, but we do have 2 touches on the upside, 2 touches on the downside. We would need 5 touches to make it a true wedge. So we would need 3 touches on one trend line, 2 touches on the other to make it a wedge there. So I don't see a particular pattern forming here. Maybe let's look on the shorter term though. I'm going to remove those drawings there. Sometimes you see a different pattern showing up on the shorter term. So in this case, it kind of almost looks like in the short term, I mean, we're still in that bit of a downtrend here. But it also looks like price is kind of finding a level of resistance right around this level as well. So that could be something to watch as well. We have our stop in place in case it does reach that descending trend line resistance. But personally, I don't really see a triangle pattern unless you are maybe looking this short term like this. So you have 2 touches on both sides. So maybe that could be what you're looking at as well. Yeah, and then you mentioned descending wedge. The only problem is it's not a descending wedge quite yet because it just doesn't have those 3 touches on one of the trend lines. It would only have 2 touches on each of them. So we can't necessarily call it a possible wedge quite yet till we get that 3 touch. But so we placed 2 trades today. We don't have enough time to place a third one. I do want to thank you all for your engagement and questions in the chat. You definitely kept Cameron and I busy. So thank you, Cameron, for helping out there in the chat. And please follow us on X, Cameron May CS, Rachel CS. I know today we did kind of cover a lot with 2 different trades, talking about the trend, talking about those shifts, and then placing those orders, all looking at our trade size and trade risk amounts as well, trying to stay in those parameters. Now, as far as if you liked this video, please give it a thumbs up. Please like this video. Please subscribe to us on Trader Talk Schwab Coaching on YouTube. And thank you all for tuning in again. I hope you stay warm out there in this entrance to winter that we're kind of seeing here. Later, traders.